Friends, welcome back to our channel OMSAI Bhojanapalli.
Morning friends. So we are doing the chapter portfolio management. In Sunday's class we had a discussion about the capital asset pricing model. Introduction we discussed. I think we have to write the notes for the introduction. We'll write that and then start doing problems in the CAPM in today's class. If possible, we'll also have a discussion regarding a concept called as portfolio beta once we do some number of problems in CAPM. So we are discussing this chapter in 5 parts: risk return profile, Markowitz portfolio theory, capital asset pricing model, short single index model, and then arbitrage pricing theory. We'll conclude the chapter by discussing about efficient market hypothesis, in which we have completed the first 2 segments, risk return profile and then Markowitz theory. After that we completed capital market line. From there we now discuss about the security market line under CAPM. Now let us have a brief notes regarding the CAPM and then continue further. Write down capital asset pricing model. Right, capital asset pricing model. Already we have completed the discussion in the previous class. Only thing is to only note down what has been discussed. Okay, please stop talking. Capital asset pricing model. Point number 1. Point number 1. Please stop talking. Okay. Before I write or before I dictate, just let us summarize this and then write it. Okay, CAPM alone, not from the beginning. Okay. Markowitz said risk can be reduced even to 0 when there is a negative correlation. But can risk be reduced to 0? No. A security risk can be classified into 2 segments, diversifiable and then non-diversifiable risk. Non-diversifiable risk is called as systematic risk and diversifiable risk is called as unsystematic risk. Even if I invest in the entire market portfolio, still there is a sigma m, the risk associated with the market itself. This systematic risk arises due to macroeconomic factors like inflation, interest rate change, exchange rates, etc. And the non-systematic risk or unsystematic risk arises due to the company specific factor like the company's product quality or product differentiation, management's ability, litigation, etc. Here we saw that a person should ask premium only for the systematic risk, should not ask premium for the unsystematic risk, because he can diversify it away. For the non-performance of his work, he cannot ask a premium from the market. So premium should be only for the systematic risk is what CAPM said. So we had an equation KE is equal to RF plus beta into RM minus RF. This is called as SML, security market line. So KE is equal to RF plus beta into RM minus RF. If I want to take no risk, the return I should require is RF. If I want to invest in the market portfolio, I want a risk premium. How much I want risk premium? RM minus RF. But if I want to invest in a given security, I want beta times RM minus RF as a risk premium. What is beta? Beta of 2 times means when the market portfolio varies by 1%, the share varies by 2%. That is what we call as the beta of 2 times. So beta less than 1 are defensive stock, beta more than 1 are aggressive stock, and beta is equal to 1 are equilibrium stocks. Then we saw that beta can be calculated in 6 ways, in which here we discuss 3 ways. Number 1, beta is equal to change in security return divided by change in market return. Second is beta is equal to standard deviation of security by standard deviation of market into correlation of security and market. Third equation is beta is equal to covariance of security and market divided by sigma m the whole square. Then we saw that this SML and CML are almost same, except that correlation is missing in the capital market line equation. The reason is there we ask a premium for the total risk or the entire risk. Here I ask a premium only for that portion which is systematic. So sigma S into RSM tell me how much is the standard deviation of security due to the correlation of security with the market. The balanced standard deviation can be called as unsystematic risk, for which one should not be asking the premium. This is what has been discussed till now. One more point needs to be discussed called as underpricing or overpricing, which I will discuss after the notes is over, and then we can just go for the problems and solutions in capital asset pricing model. I think for the past two classes, not so many sums have been discussed, and the sums will be very easy. When I discuss, it may be difficult. Sums are all very easy because context has been understood, and we have to only put the numbers and do the calculations. Can you start or not? Write down notes. Capital asset pricing model notes. Point number 1. Point number 1. Markowitz states that when correlation is -1, Markowitz states that when correlation is -1, then by constructing an optimum portfolio, when correlation is -1, then by constructing an optimum portfolio, risk can even be reduced to, by constructing optimum portfolio, risk can even be reduced to 0. Risk can even be reduced to 0. Point number 1 or 2? 2. CAPM states that even when we have 100% diversification, risk cannot be reduced to 0. Risk cannot be reduced to 0. Risk cannot be reduced to 0. Point number 2 or 3 or 3. CAPM classifies risk into two types. CAPM classifies risk into two types. CAPM classifies risk into two types. Branch it into two. Systematic risk. Second branch is unsystematic risk. Systematic risk and then unsystematic risk. Systematic risk, put it down and I can write. It is also called non-diversifiable risk. It is also called non-diversifiable risk. And it exists for the entire market. It is also called non-diversifiable risk and it exists for the entire market. Continue. It arises due to. Tell me, systematic risk arises due to macroeconomic factors. It arises due to macroeconomic factors. Like It arises due to macroeconomic factors like inflation, interest rates, GDP growth, inflation, interest rates, GDP growth, exchange rates, etc. Inflation, interest rates, GDP growth, exchange rates, etc. Can I proceed? Go to the next branch. Unsystematic risk. Put a down arrow and write. This risk is company specific. This risk is company specific. This risk is company specific and can be avoided through. This risk is company specific and can be avoided through diversification. This risk is company specific and can be avoided through diversification. Examples are companies, product quality, management team, product quality, management team, innovation ability, litigations, etc. Innovation ability, litigation, etc. Everybody following or not? Next. Point number 2 or 3 or 4 or 4. CAPM gives an equation. CAPM gives an equation to calculate. Required rate of return. CAPM gives an equation to calculate required rate of return for a security. CAPM gives an equation to calculate required rate of return for a security with a given level of risk. Required rate of return for a security with a given level of risk. It is called SML equation. So I think you should explain it. What is SML? Security market line. It is called SML equation. So write the equation below that. KE is equal to, tell me the equation, RF plus beta into RM minus RF. K is equal to RF plus beta into RM minus RF, where RF is equal to risk-free return. RM is equal to tell me, RM is equal to what? Return on market portfolio. RM is equal to return on market portfolio. Just to confirm, last class we discussed how to find return on market portfolio. Take the index movements as capital gains. Dividend yield will be published by the stock exchanges. We can find out the return on market portfolio. RM is return on market portfolio. RM minus RF is equal to RM minus RF is equal to call as market risk premium. RM minus RF is equal to market risk premium. Beta into RM minus RF is equal to security risk premium. is equal to security risk premium. Very simple. I want a premium of RM minus RF. If I invest in what portfolio? Market portfolio. If I invest in a given security, I want RM minus RF or differently. What is the premium I want? Beta times RM minus RF is the security risk premium. Everybody following or not? Next. Point number 4 or 5? Yeah? 5. Point number 5. What is beta? Point number 5. What is beta? What is beta? That right? Point A. That right? Point A. Beta measures security risk. Beta measures the security risk in relation to market risk. Beta measures security risk in relation to market risk. Beta measures security risk in relation to market risk. Point B. Beta is equal to 2 means, point B, beta is equal to 2 means when market return varies by 1%, beta is equal to 2 means when market return varies by 1%, when market return varies by 1%, the security return varies by, how much percent? 2%. The security return varies by 2%. The security return varies by 2%. That is, the security is 2 times. That is, the security is 2 times riskier than market. That is, the security is 2 times riskier than market. The security is 2 times riskier than market. Point B or point C? Point C. The beta can be calculated in 3 ways. Point C. 6 ways we'll discuss next 3 later, okay? Now the beta can be calculated in 3 ways. The beta can be calculated in 3 ways. The beta can be calculated in 3 ways. Branch it into 3. Branch it into 3. First branch, right? Beta is equal to, write the formula. Beta is equal to what the formula? Change in security return divided by change in market return. First branch is change in security return divided by change in market return. Second branch, beta is equal to standard deviation of security divided by standard deviation of market into correlation of security and market. Standard deviation of security divided by standard deviation of market into correlation of security and market. Can I proceed? Now, third, beta is equal to covariance of security and market divided by standard deviation of market the whole square. Covariance of security and market divided by standard deviation of market the whole square. Now, these 2 formulas are same only. It is rearranged, that's all. Everybody following or not? Next. Point B or C or D? Point E. Point D. Beta represents only the systematic risk portion of the security. Beta represents only the systematic risk portion of the security. Beta represents only the systematic risk portion of the security. Beta represents only the systematic risk portion of the security. Next point, D or E? E. Stocks in the market. The stocks are securities you mean, okay? Stocks in the market can be classified into 3 types. Stocks in the market can be classified into 3 types. branch it into 3. Aggressive stocks, branch it into 3. Aggressive stocks, equilibrium stocks, aggressive stocks, equilibrium stocks, and third is defensive stocks. Aggressive stocks, equilibrium stocks, and defensive stocks. Aggressive stocks, put a down mark and write beta greater than 1. Beta greater than 1. Equilibrium stocks, beta is equal to 1. Equilibrium stocks, beta is equal to 1. Defensive stock, beta less than 1. Defensive stock, beta less than 1. Can I proceed or not? Next point number 5 or 6 or? Point 6. Next point is point 6. CML versus SML. Capital market line versus security market line. Capital market line versus security market line. Capital market line versus security market line. Can I proceed or not? Next. Write CML, underline that. Write CML, underline that. Tell me the formula RP. RP is equal to, return of portfolio is equal to what? RF plus sigma P by sigma M into RM minus RF. RP is equal to RF plus sigma P by sigma M into RM minus RF. Can I proceed? Next. SML. What is SML? KE is equal to, like RP we call as what? KE. Notation may change, the thing is what? Same. Is equal to what? RF plus sigma S divided by sigma M into correlation of S and M into RM minus RF. Sigma S by sigma M into correlation of S and M into RM minus RF. Can I proceed or not? Now, continue writing in the right point A. In the right point A. CML, RP is nothing but SML's KE. So you don't get confused about the term. CML RP is nothing but SML's KE. Capital market line, what is the required return of portfolio called na? That is as what? Required return of security. The security even can be a portfolio of securities. Okay. CML RP is nothing but SML's KE, and CML's sigma P should be understood as SML's sigma S. CML's sigma P should be understood as SML's sigma S. CML sigma P should be understood as SML sigma S. Everybody following or not? Next, point B. In CML, the risk-averse investor, in the CML, the risk-averse investor asks risk premium for. In CML, the risk-averse investor asks the risk premium for. Ask the risk premium for what? The entire sigma P. The risk-averse investor asks the risk premium for the entire sigma P. That is, premium is required for. That is, premium is required for the total risk. That is, premium is required for the total risk. That is, premium is required for the total risk. Respond. I will follow you not. Next. Point B as here. C. In SML, the risk premium is not for in SML, the risk premium is not for the entire sigma S. The risk premium is not for the entire sigma S. It is not for the entire standard deviation of security. It is not for the entire S. It is only for that portion of sigma S. It is only for that portion of sigma S. It is only for that portion of sigma S which is correlated to the market. It is only for that portion of sigma S which is correlated to market. It is only for that portion of sigma S which is correlated to market. Everybody are you understanding or not? That is CAPM states that an investor should ask risk premium only for, that is CAPM states that an investor should ask risk premium only for, an investor should ask risk premium only for what risk? Systematic risk. The investor should ask risk premium only for systematic risk. The investor should ask risk premium only for systematic risk because unsystematic risk can be diversified away. Because unsystematic risk can be diversified away. Unsystematic risk can be diversified away. Up to this, everybody, are you comfortable or not? Now, let me discuss now the last segment called as underpricing or overpricing. Very small issue. We will start doing the problems. Okay. Give the heading. Identifying asset underpricing or overpricing. Give the heading. Identifying asset underpricing or overpricing using CAPM. Identifying asset underpricing or overpricing using CAPM. Identifying asset underpricing or overpricing using CAPM. Using CAPM. Okay. Shall we start or not? Scale. One scale. No scale, okay. Then stop talking. Why you are talking? Tell me. Why break? Now only started a class, please. Shh. So, till now, what has been discussed? Are you having the clarity or not? Yes or no? Now, see. Value of an asset. We saw value of a bond, anything. Na? What is the value of an asset? Present value of the future benefit discounted at the required rate of return of the value. So asset value depends on two things. What is the future benefit I'll be getting from it? Number two is the certainty of that benefit, which we call as what? Risk. Right or not? So if the risk is more, then the discount rate will be more. If the risk is less, the discount rate will be less. More the discount rate, less the value. Less the discount rate, more the value. That's how we value the asset. Respond, yes or no? Now, I said that at the beginning of the chapter, the main aim of this chapter is to find the discount rate for valuation. You know, benefits we can measure. We can measure the benefits, But the benefit will be having a risk or standard deviation. For that risk, what should be the discounted? You should be asking that CAPM has answered, yes or no? For a given level of risk, the discounted you should be asking is what? RF plus beta into RM minus RF is the required rate. We call that as what rate here? Required rate. Everybody, can I proceed or not? Now, see. Let us take for example equity shares. We have valued equity shares in so many formulas or not? Now, I forgot. Tell me what is Walter model for share valuation? P0 is equal to? P0 is equal to? First of all, everybody answer. P0 is equal to what? D plus R by KE. Everybody listening? Now, D plus R by KE into E minus D divided by KE. What is the Gordon's model? E into 1 minus B divided by KE minus BR. It's nothing but DGM formula. D1 by KE minus G. What is Modigliani-Miller approach? What is the D? N plus M into P1 plus I minus E divided by 1 plus KE. Single holding period P0 is equal to D1 plus P1 divided by 1 plus KE. You know, right or not? Yes or no? No. And we can also say P0 is equal to EPS by KE. All this, the benefit you measure differs. Okay. In one case, I measure the benefit as a perpetually growing dividend. Another case, I measure the benefit as what? EPS and so on. But there are so many ways in which I can value measure. Yes or no? More formulas you will see in the equity valuation chapter later. But in all valuation, KE is used for discounting. Enna parita na? Okay, the formula measures the benefit. Suppose I say from an equity share, I am going to get growing dividend. I am going to get what? Growing dividend. So what is the formula for that? P0 is equal to D1 by KE minus G. There is nothing but present value of a growing perpetual dividend. Like that, we just discount the present values, we discount the cash flows to find out the present values by using the appropriate formula. Everybody, yes or no? Okay, now. This D1, G and all, known numbers are unknown, all are estimates. All are not for the past dividends. Past may be used to predict future, that is different. But what is predicted is only what? Future. We can use scenario analysis, I can use what? Past record. Anything here, future prediction is future only, yes or no? Thus D1, G and all is uncertain. They have an uncertainty. Is measured through what? The standard deviations. What I am saying? So, these two are nothing but what? Predictions only. So, don't say I am predicting two things here. First year dividend, second year dividend, third year dividend, fourth year dividend. I do the prediction of the dividends or not. And these dividends are all predictions only. They have their own risk. Yes or no? For the risk only, I have a discounted call as what? KE. Now, the question is, for the company shares, there's a share of X Limited. For this X Limited shares risk, X Limited we project a dividend, we project what? Growth. For example, in this formula, we project a dividend and then what? Growth. For this, there is going to be risk or not? The risk can we calculate. We can calculate sigma S. We calculate risk as what? Sigma S. Standard deviation of the security is written. For that sigma S, how much I should ask for return? Question arises no. For that only SML equation comes RF plus what? Beta into RM minus RF. Question. Did you understand the discussion or not? Now, very simple. Again I say, this formula is nothing but P0 is equal to present value of D1 to D infinity. Correct? Now, I am only taking one of the formulas. Any formula can be what? Taken. It all depends on how you project the shares benefit. Right or not? Now, this formula is nothing but what? Present value of what? D1 to D infinity. Accepted. Now, D1, D2, D3, D4 and all agreed amount. Astrologer said only, it is like what? Astrology only. So all these are what? Estimates are predictions only. All these are what? Predictions. This prediction may prove true, may not be what? Proving true. It may be more, it may also be what? Less. There's a risk in this prediction. Yes or no? They measure through the standard deviation. Measure through what? Standard deviation. Which I can measure either through past or what? Scenario analysis, that we know how to measure it. Right or not? Now, for that risk, the risk is what we call as sigma S. We call as what? Sigma S. Because for the security, we have these cash flows. These cash flows has got their what? Own risk, which we call as what? Sigma S. Standard deviation of the security return or cash flows. Yes or no? For this standard deviation, I should ask a return or not? The return should be calling us what? KE. That should be the discount rate. Enna return or not now? So, how does the KE, what they said is, use the market as a benchmark. Use the market as what? Benchmark. If you take sigma m as a risk, if you take what? Sigma m as a risk, you should ask KE as what? RM. Correct? Now, if the standard deviation is what? Sigma m. Security standard deviation is what? Sigma m. If I invest in market portfolio, what should be the KE? RM. How it is RM? Because if you see the equation, K is equal to what? RF plus our beta is what? 1. I get what? RM minus RF. It gets what? Cancel. So, if I invest in a security which is similar to market, in a security which is going to be what? Similar to market, the K, what I should ask is what? RM. Yes or no? Now, am I investing in a security which is having a standard similar to market? No. It may have less than that or more than that. Less than that or what? More than that. Okay. Now, here I have a standard deviation. Yes. I have standard deviation what? S1. I can ask what standard deviation? S2. Two situations. Everybody, are you following or not? Now, in that case, I will be asking for more return or less return or less return, because I will fall a point in this line. Yes or no? Here I will be asking more return or less return or more return. I fall in this particular line. Respond yes or no? So what CML says, listen here, what CML says is that, so this is called as what? RF. For investing in M, the premium I want is what? RM minus RF. For a sigma M risk, for what risk? Yeah? Sigma M risk, the premium I want is what? RM minus RF. Enna paritana? For sigma S2 risk, for what sigma S2 risk, what I do, the premium I want is sigma S2 divided by what? Sigma M into what? RM minus RF. Everybody follow not? To put it simply, RM minus RF is for sigma M. Yes or no? For every sigma, I require how much premium? RM minus RF divided by sigma M. Get it? RM minus RF is a premium. RM minus RF is what? Premium. For what risk? Sigma M risk is for what risk? Sigma M risk. For every unit of risk, how much premium I want? RM minus RF divided by sigma M is the premium I want for every unit of risk taken. Yes or no? How much I am taking here? I am taking sigma S2 risk. I want so much premium. Yes or no? And if you come downwards, then I'm going to take what? S1 risk, so much premium. This is what I call as the required rate of return of a security under CML. In our return, only change what we make is, in case of the capital pricing model, instead of sigma S2 and what? Sigma S1 and sigma M, I call as, this is for beta is equal to 1. This is for what? Beta of the security. This is also for what? Beta of the security. The slope is not the standard deviation. The slope is what? Beta. In a paritana. Now, I'll give a simple example. See, suppose there's a security which is having a standard deviation of 8%. How much percentage? 8%. Should I ask risk premium? No. It all depends on the correlation. The correlation is 0. The correlation is what? 0. That means I should not ask what? Risk premium, because it's not correlated with what? Market. The risk premium should be asking is what? 0. They say father should be asking only what? Risk free return. Yes or no? Now, in the other case, I'll be asking what? Premium for that. Here I am going to ask only for what? Systematic risk. The slope for this is not the standard deviation of the security. The slope for this is what? Beta of the security. The difference between the SML and then what? CML. Point number 1. Are you following what I am saying? So, now how to identify underpricing or overpricing? Very simple. Now, they'll give you a problem where they say there is a equity share which is expected to pay a dividend of D1 is equal to 2 rupees. How much dividend here? 2 rupees. We expect to have a growth rate of, suppose, 6%. What is the growth rate? 6%. Now they say, find out the value of the share. Find out the value of the share. Now we should find out the value of the share or not. For that I require what? KE. For that KE, what I should do is, I find out KE is equal to what? RF plus beta into RM minus RM. This is a required KE. I don't want to find out the KE is equal to RM plus beta into RM minus RM. For example, suppose the risk-free return is going to be 4%. What is the risk-free return? 4%. And beta is 2 times. Market return is 9. And risk is going to be what? 4. So tell me what is required return here? It is 4% plus 2 into what? 5 gives what? 10%. Is it correct? So I want from this share how much return? 14%. The return required is how much percentage? 14%. Everybody yes or no? Now you apply the formula P0 is equal to what is 2 divided by what is KE? 14%. What is growth rate? 6%. Everybody understanding or not? Tell me 2 divided by 14 minus gives how much here? 2 divided by 8%. Is it how much? 25. That means this share should be trading in the market at how much base? 25. If it is trading in the market at 25, then this security goes into this line. The security goes into what this particular line. It should be trading in what market? How much base? 25. If the security is trading in the market at 25, in that case, I put like this. If the security is trading in the market at 25, I also value at what? 25. Is it overpriced, underpriced, perfectly priced, perfectly priced? It is priced as per the SML. Now, suppose I buy this share for 25. I buy this share for how much base? 25. Okay. Now, here cash flow. Okay. Today year 0. I invest how much base? 25 on the security. Right or not? Now, cash flow. I am going cash flow for 1 year or 2 years, infinite years, infinite years. I get 1 to infinity. What I get? D1 to what? D infinity. At what rate? Growth rate G. In my son, no. Now, that is going to be 2 to D infinity. Growing at what rate here? 6% growth rate. In my son, no. Now, this is an investment for me or not? For this investment, that's going to be an IRR. Yes or no? The IRR is something where KE. IRR is something but what? KE is equal to D1 by B0 plus G. Everybody follow what I am saying? Now, if I invest at 25, what is my IRR? The IRR is D1 by P0 plus G. This is the IRR for a growing perpetuity. Level perpetuity very simply. I have discounted cash flow is equal to cash flow by R. R is equal to what? Cash flow by discounted cash flow. Here it is not cash flow by discounted cash flow plus what? Growth also done because IRR for what? Growing perpetuity. If I calculate IRR, what is D1 2? What is P0 25 plus G is what? 0.06. What is 2 by what is 2 by 25? 0.08 plus 1 0.06. How much percentage? 14%. Respond. Are you following or not? Now, I'll put the discussion this way. If I buy the share at how much base? 25. I can earn my required return of 14% from this share. Now, if I pay 25 and buy this share, how much I will earn? 14. As per SML, how much I should earn? The CAPM said you should earn what? 14%. For the risk taken, you should earn how much percent? 14%. I can earn the 14% from the share market only if I buy the share at 25. Suppose the share is trading at 26. Trading at what? 26. Will I earn 14%? Less than 14? When investment price increases, the return investment what? Decreases. I will earn what? Less than 14. I will not earn what I require. I will not buy that share. Now, if I buy the share at 20 rupees, happier. I will not speak. Immediately what? Why? Because in that case, 2 by 20 is what? 10%. That's I will be earning how much percentage? 16%. But for this, I should be only requiring how much percentage? 14%. So, what we should do is, how to identify underpricing and overpricing? Very simple. Use the share valuation formula. Any formula can be used. Mostly in examination, they ask you to use what? DGM formula only. What is the formula for share valuation? DGM, D1 by KE minus G. In that formula, the KE, what I should use is what? SML KE. Using that, you find the share price. This share price compare with what? Market price. And if the market price is more, the market is what? Overpricing. Market price is less, the market is what? Underpricing. Market price is same, it is perfectly priced. Based on the decide whether to buy it or not to buy it. Right or not? Now, the next question is, suppose the share there is, if the share is trading at situation, how much rupees? 25 rupees. Then this stock is expected to give, how much return? I use the word now, expected to give, because all these numbers are expectation, not actual. Expected how much percent return here? 14% return. Please, can I proceed or not? Now, I'll give you two situations. Situation number 2, here, cash flow. I pay 20 rupees. In the market, the share is trading how much rupees? 20 rupees. And 1 to infinite years, I get how much dividend? 2 to D infinity. Yes or no? First year 2, second year what? 2 into 1.0 etc. is growing at how much percent? 6%. This is my investment. Yes or no? Now, for this I have to calculate IRR or not. Tell me what is IRR? KE is equal to D1 by P0 plus G. Now, what is D1? 2. What is P0? 20. What is G? 0.6. Tell me K is how much percentage here? 16%. Ennappa, right or not? Now, there are 2 KEs. There are what? 2 KEs. Now listen, there are how many KEs here? 2 KEs. One is, I found out KE as 14%. That's another KE. K is what? 16%. What is this 14%? What is this 16%? Question arises now. This is called as required KE. It is called as what? Required KE. It is called as expected KE. You know what I am saying? Either required return. It is called as what? Expected return. To put it simply, this return is not coming from the price. It's not coming from what? Price. It's derived from the risk. Yes or no? Now, for a share, we is having 2 times beta. What time is having what? 2 times beta. I should ask a return how much percent? 14%. This is a very fair return, very logical return. I should ask from the market. So, what should I ask the market? 14%. I ask the market how much percentage? 14%. But this is a return the market is expected to give because the share is not trading at 25, it is trading at what? At 20. The share is trading at an equilibrium price, 25. Then what they require, what market is expected to give, both are what? Same. But now the share is trading how much rupees here? 20 rupees. In that case, from 20 rupees for the same cash flow, I expect the market to give me how much percent? 16%. Don't say whether it is certain or not. And it is also having what? Uncertainty. For the uncertainty, premium is already asked. Yes or no? In that case, the market is expected to give for this price how much return? 16%. But the share is required how much return? 14%. Is expected more than what I require or not? Yes, I'll buy the share under price. The other way to find out is I can find out underpricing and overpricing 2 ways. One method is put the SMLKE. Put the SMLKE into what? The share valuation formula. Put the SMLKE into share valuation formula and find the equilibrium price. What is the equilibrium price? 25 rupees. This we compare with what? Actual price. Actual price more means what? Overprice. Less means what? Underprice. Method number 1 of identifying underpricing or overpricing. The second method of identifying underpricing and overpricing is very simple. Find out the SMLKE. What is SMLKE? 14%. Which I give the name what return? Required return. Also find out another K which is IRR. Another K is what? IRR for the actual market price. Remember? Another K is what? IRR for actual market price. In this case, K is equal to D1 by P0 plus G. How much percentage? 16%. The expected IRR is what? 16%. What I want is what? 14%. So, the capital budgeting, I expect to earn 16%. I want cost of capital 14%. Yes or no? In that case, IRR more than cost of capital or not? Yes. The share is underpriced by it. Yes or no? Now, if the expected return is what? Less than the KE, then what I should do? Overpriced, do not buy it. Any appreciate that? Repeatedly ask examination question. Everybody, are you following or not? Any appreciate that? No. You should tell me the last conclusion. Now we are discussing the area called as what? Underpricing or overpricing. Now, tell me, first of all, underpricing or overpricing can be identified in how many ways? 2 ways. By comparing the prices or by comparing the returns. This bond we discussed here by comparing yields and by comparing what? Prices. So underpricing, overpricing can be found out in 2 ways by comparing the prices, by comparing the return. Now, there are 2 prices for the share. One is the actual price, another is the fair price. One is actual price, another is what? Fair price. Actual price is quoted in the stock exchange. Fair price, what we should do? We should calculate. What is the price of the share? D1 by KE minus G. This is one of the formula. Normally, price of the share is the present value of the future benefits. I use here D1 by KE minus G. In that, what should be the KE? RF plus beta into RM minus RM. That's the equilibrium return. Yes or no? Now first find out KE using what? SML return, and then that KE should be used as a discounted. I find the price. This price is called as what price? Fair price. The share should be trading at 25. But the actual price is how much? 20. Share is overpriced, underpriced, underpriced. Buy it. If the actual share is trading at 30 means what? Overpriced. Do not buy it. Point number 1. Accept or not. This is one way of identifying underpricing or overpricing. by comparing the actual price with what? The fair price. What is fair price? Valuing share using the SML discount rate. Price are using what? SML discount rate, which we call as what price? Fair price. Fair price gives me required return. Gives me what? Required return. Actual price gives me what? Expected return. What I am saying now. Next, other way to find out is compare the returns. Find out required return. What is required return? RF plus beta into RM minus RF. This required return depends on the market price. It depends on the risk of the share. Risk of the share. For this risk, I should require how much percent? 14%, which we get as required return, where you take the market portfolio as a benchmark. Yes or no? So the required return is how much percent? 14%. Calculate the expected return using what price? Actual price. It is nothing but IRR. It is nothing but what? IRR. The expected IRR is called as expected return. The required return is nothing but what? SML return. Compare what is expected from what is required. What I expect from the share is more than what I require. The share is good or bad? Good. Buy it. What I expect is less than what I require. The share is good or bad? Bad. Don't buy it. What I expect is equal to what I require. The share is what? Equilibrium star. We can be indifferent. Right or not? Are you following what I am saying? Either we call as underpricing or overpricing. Just for technicality, what happens is we had a diagram here. We had a diagram here. See. In this diagram, for example, the share is having a beta of 2. So having a beta of what? 2 times. Okay. Now. One minute here. Okay, this is beta is equal to 1. Now, if you look at my example here, look at this. RM is how much percent? 9%. This is RF. This is what? RM. What is RF? 4%. RM is what? 9%. I want a 5% risk premium for taking a beta of what? 1. My share is having a beta of 2 times. No? 2 will be right hand side or left hand side or right hand side. My share is having a beta how many times here? 2 times. In the example, now, a share, I'll tell you about the share. A share which is expected to pay a dividend of 2 rupees next year, which is expected to grow at how much percent? 6%, is having a beta how many times here? 2 times. Is trading in the market. Is what trading in the market at rupees 20. Example, trading in the market how much rupees? 20. Somebody asks you, can I buy this share or not? Now, see the situation. There is a share. There is a share which is expected to pay how much dividend? 2 rupees. When? Next year. And it's going to continue to pay 2 rupees? No. It is expected to grow at how much percent? G%. These two are actuals or predictions. This is what? Prediction. It is having a risk or not? The risk is what? The beta. Having a beta how many times here? 2 times. Having a beta of 2 times. And it is now trading in the market at how much rupees here? 20 rupees. I ask you, can I buy this share or not? Question. Now, what do? You have to price the share. Okay. Now you said, the share is worth how much? 25. It is trading at what? 20. Hence it is underpriced. Buy it. Is one way of understanding it. Any question? Now, see, let's understand it more logically. See. For the beta of how many times? 2 times. The return I should require is how much percent? 14%. Now look at this. That means for beta of 2 in the CML, the return should be how much percentage here? There should be what? 14%. The K should be how much percentage here? 14%. Everybody, are you following what I am saying? For the 2 times beta, I should require how much return? I should require how much return? 14% return as per the CML. Yes or no? This 14% return I will earn if the share is trading at how much rupees? 25 rupees. Yes or no? But what happens is, this share is trading at 25 rupees or 20 rupees or 20 rupees. Yes or no? In that case, for the beta of 2, will I earn 14% more than 14 or more than 14? Because for 20 rupees share price, I'm getting how much return? 16%. So from this share, the expected return is somewhere here. It is how much percent? I just included. How much percentage it is? 16%. The expected return is 16%, but the required return is how much? 14%. Tell me, I am on efficiency frontier, above efficiency frontier, above efficiency frontier. It is more efficient than efficiency frontier. Yes or no? Now, like Markovits don't say that, sir. This is not efficiency frontier. I cannot say because I am taking market as a representative. Either one of the best I can take, then I cannot have any model for valuation. Yes or no? I consider this to be what? Efficiency frontier. When I find a stock more than that, what happens? The market has underpriced. Apna market is not in equilibrium. Market has what? Underpriced. They said don't worry about that because all people start buying this stock. When I start buying the stock, the 20 rupees will be 20, will be increasing. It becomes on 25, goes into the sign. I will follow what I am saying. Like a river, when there is a flood, what happens here? It crosses the boundary. Once again, what? It comes back. Tsunami came here, the entire globe, what I am saying, immersed in water. No, it came and then what? Went back. Then the boundary is maintained. Right on what I am saying? Like that. That can be a crossing of efficiency frontier. Serious or சொல்றேன், yeah, okay. We are having in share market securities, which is what? Crossing efficiency frontier may be there, but don't say that, then I don't take this as what? Equilibrium return. The operation side maybe what? More or less, but after some time it will be coming back to what? Efficiency frontier is what we always believe in market economy. Everybody, are you following what I am saying? So in that case, if it is trading at 20, the share is giving a return more than the SML return, I'll buy the share. This I call as expected return, which we call as what? SML return. If expected return is more than what? SML return, I'm above the efficiency frontier. Yes or no? Now, suppose the share is trading at 30. How much is it? 30. It will be above SML, below SML, below SML is called as what? Expected return. I'll buy the share, will not buy the share, will not buy the share. Due to this, what happens? There will be no demand. Then the price decreases. It becomes 20, means what? Goes in the market portfolio. Everybody, are you following what I am saying? That is one should be understanding the underpricing or overpricing. Yes or no? With this, the last discussion also over. Based on this, only I are going to have number of sums. Another 5 or 6 sums will be doing, in which it will be either calculation of beta, identifying the underpricing or overpricing. Now you are able to understand the full CAPM or not? Now, understand that it is not capital asset, it is not security pricing model. The name given is what? Capital asset pricing model. This can be used even to value my project. It can be used even to value my house. It can be used even to value what? Gold. Because beta of anything can be linked with the market. Everybody is so no. Now, when I want to take a project, here. How in a share I make a 20 rupees investment, I project cash flow. Like that. In project I can what? 20 crores investment. Yes or no? I'll be making what? Cash flows. This cash flow is not a risk or not? For the risk, how much do you want? Use SML K to want to find it out. Everybody, yes or no? I want to buy a house. I invest some money today. Yes or no? Is an investment. I get rental incomes and what? You expect a salary later or not? All those are what? Prediction. The rental income is having a standard deviation or not? Further calculate beta with the market. How the house trend moves with what? Market. And then find out what? Value of the house. Yes or no? Any capitalist in the world can be found out. Value can be using what? Capitalist and pricing model. Your work is to estimate what? Cash flow and find out risk. And they will give you what? Discounted. Then you can find out the value of any asset in the world. So the model is called as what? Capital asset pricing model. It helps you to price a capital asset and compare with what? Market price to identify underpricing or overpricing and make appropriate decisions. Everybody following on mostly in today's world, good projects, big companies projects are all valued only using what? The CAPM discount rate. We'll see in levered beta, unlevered beta, how for a project they estimate what? Beta and do it. Everybody following on? So this is regarding the capital asset pricing model, introduction getting fully completed. So now what we are discussing is what? Underpricing or overpricing. Right down in that, right? Point number 1. The last two notes. Okay, point number 1. Even if you ask, I won't dictate any further notes. Okay, point number 1, last notes. CAPM can be used to identify whether CAPM can be used to identify whether a security is underpriced or overpriced. CAPM can be used to identify whether a security is underpriced or overpriced. Whether a security is underpriced or overpriced. Everybody following or not? Next, point number 2. For example, point number 2, for example, there is a security, for example, there is a security which is expected to give, there is a security which is expected to give a dividend of, there is a security which is expected to give a dividend of rupees 2, growing perpetually at, is expected to give a dividend of rupees 2, growing perpetually at 6%, and has a beta of, when I say dividend growth, it is having a risk or not? The risk is measured through what? Beta. And having a beta of, and having a beta how many times? 2 times. And having a beta of 2 times. And having a beta of 2 times. This is trading in the market at rupees 20. This is trading in the market at rupees 20. The treasury bill gives, treasury bill means what? Risk-free asset. The treasury bill gives, the treasury bill a 4% return. The treasury bill gives 4% return, and market portfolio gives, and market portfolio gives 9% return. A treasury bill gives 4% return, and market portfolio gives 9% return. Should we buy this security? Should we buy this security? Should we buy this security? So, from this, to make a decision, tell me what are all the data you should require here. What future benefit you expect from the security? Number 1. What is the risk of that benefit, which you call as what? Beta. What the government of India is offering as what? Interest rate. And what the market portfolio stock index is what? Offering you. If you know all these 4, I can know how much I should ask from the security and find out its price. Enough, write down not. Next, write down. Point number 2 or 3 here? 3. Taking market portfolio as benchmark, taking market portfolio as benchmark, taking market portfolio as benchmark, comma, the return we should require from the security is, taking market portfolio as benchmark, the return we should require from the security is, the return we should require from the security is, by the equation KE is equal to, the return we should require from the security is, K is equal to, what's the equation? RF plus beta into, K is equal to RF plus beta into RM minus RF. RF plus beta into RM minus RF. 4% plus 2 into, 4% plus 2 into 9 minus 4. 4% plus 2 into 9 minus 2, 4. Which is equal to how much here? 14%. It is equal to 14%. So what should you want here? 14% is equal to 14%. This is also called, same point to continue, this is also called, I call now as required return, no? It is also called equilibrium return. It is also called equilibrium return or SML return. It is also called equilibrium return or SML return. It is also called equilibrium return or SML return. Equilibrium return or SML return. Everybody understanding it or not? Next. Point number 3 or 4 or 4. The fair price of the share is. The fair price of the share is. Stop writing and tell me what is the price of any share. Present value of future benefit. What is fair price? Present value of future benefit discounted equilibrium return. Yes or no? The fair price of the share is the present value of its future benefits. The fair price of the share is the present value of the future benefits, in bracket growing perpetuity. The fair price of the share is the present value of future benefit, in bracket what is the future benefit? Growing perpetuity, bracket close, discounted at what return? Equilibrium return. Discounted at equilibrium return. Right? P0 is equal to, so we all know the growing perpetuity, discounted cash flow. What is for level perpetuity? Cash flow by R. What is growing perpetuity? Cash flow by R minus C. Inga R is what? Yeah? Equilibrium return. That's all. Yes or no? P0 is equal to, what's the formula? D1 by Ke minus G. P0 is equal to D1 by Ke minus G. P0 is equal to D1 by Ke minus G. 2 divided by what minus what? 14% minus 6%. The sum evaluating 2 divided by 14% minus 6% is equal to 2 divided by 8% is equal to 25. 2 divided by 8% is equal to 25. Continue. The share is worth 25. Same party continue. The share is worth 25 but trading at 20. The share is worth 25 but trading at 20. Hence it is what? Underpriced. But trading at 20. Hence it is underpriced. Buy it. Hence it is underpriced. Buy it. Can I proceed or not? Next. Point number 3 or 4 or 5? 5. Alternatively, one can compare returns. To make the decision. One can compare the returns to make the decision. Continue. If we buy the share at 20, the cash flows are as follows. The cash flows are as follows. Okay. Year 0, right, 2 columns, year cash flows. Year 0, inflow, outflow. How much I paid to buy? 20. Year 0, outflow, 20. 1 to how many years? Infinity. 1 to infinity. I get what? 2 to what? D infinity. I get 2 to D infinity, growing at how much percent? 6%. I cannot write 2, then 2.3 and so on. Instead of writing, let's say what? 2 to D infinity, growing at 6%. Write down. The IRR, continue. The IRR or return on investment. IRR is nothing but return on investment only. Okay, the IRR or return on investment is, KE is equal to 2 divided by 20 plus what? A growth rate of 0.06. K is equal to 2 divided by 20 plus 0.06. Very simple. I invest 20. I get how much return? 2. That alone I get no. I also get what? A growth of 6%. 2 by 20 is the normal return. Plus 6% is a growing return of 16%. Is how much percent? 16%. The IRR is 16%. Can I proceed or not? Next. Point number 5 or 6? 6. When we purchase a share at 20, the expected return is 16%. When we purchase a share at 20, the expected return is 16%. The expected return is 16%. But for this share based on its risk. But for this share based on its risk, the required return is only, but for this share based on its risk, the required return is only how much percent? 14%. The required return is only 14%. The required return is only 14%. Since expected return exceeds, required return, since expected return exceeds required return, the share is underpriced. Expected return exceeds required return, the share is underpriced, buy it. The share is underpriced, buy it. The share is underpriced, buy it. Are you having the clarity or not? No. Last point, 6 or 7? 7. Point number 7, have the following columns. Okay. First column, SML return. First column have SML return. Is also called as a required return. Okay, SML return. Second column, expected return, which is normally called as IRR for the actual price. A required return, expected return. Third column, actual price. Fourth column, fair price. Last column, under or overpriced. SML return, expected return, actual price, fair price, under or overpriced. Under or overpriced. Now, you should think and tell me, I write the first two, you should fill the last 3. Can I person or not? Now, SML return less. SML return less. Expected return more. SML return less. Expected return more. Now, in this case, tell me, the actual price will be more or less? Because actual price is found out using expected return and fair price using what? SML return. Now, for the actual price, the discount rate is what? Expected return. For the fair price, how much? SML return. For discounted more rate, the price will be what? Less. The actual price is less. FP, I discounted what? SML. The discounted what? Less than the actual. Fair price is what? More. The fair price is more. The fair price is more. Fair price more than what? Actual price. Under or overpriced? Yeah, underpriced. The underpriced or overpriced? Underpriced. Very simple. Yeah, this is a current example. I wanted 14% return. But I got how much percent return? 16. Why I got 16? Because share is trading at 20. You should have been trading at how much rupees? 25. This is example number 1. Right or not? What I am saying? Now. So, now, once again tell, actual price is found out by discounting at what return? Expected return. And fair price is found out by discounting using what return here? SML return. Otherwise, SML return will be giving you the fair price. Actual price gives you what? Expected return. Can I proceed? Now, remaining you should tell me same. SML return same. Expected return same. I wanted 14. It all gave me what? 14. So the share is trading at same price. Fair price also is what? Same. Everything is same. Everything is what? Same. Then share is what? Perfectly priced. The share is perfectly priced. What I want, what I am getting. So how much I want to pay is what is priced. Going to be perfectly priced. Can I proceed? Now, SML return high. SML return high. Expected return less. Expected return less. I want 14. The share is giving only how much? 12%. The share is overpriced, underpriced, overpriced. The actual price is what? High. And the fair price should be less. The share is overpriced. Actual price is high and the fair price is less. The share is overpriced. The share is overpriced. With this, we complete our discussion regarding the underpricing or overpricing. Everybody respond yes or no? Now, let's start doing the problems. See, question is KE is SML or expected. Very simple. If you find out KE from risk angle, it becomes what? SML. If you find out KE from the price, it becomes what? Expected. See, very simple here. K is equal to RF plus beta into RM minus RF is called as what? SML KE. K is equal to D by P0 plus D. If I find out IR of the actual price, it becomes what? Expected return. That's all. Rendume KE thampa. Return not. And the expected return is what? Required return. Should I repeat? Can I proceed? Everybody, are you all following? No. I want a response. Those who follow, raise your hand. Can I proceed? No. Shall I proceed further? No. Let's start doing the problems in this regard. Now, again, very simple. There are two returns. All of you, how many returns here? Two returns. Name the two returns. Expected return and required return. Please. How much return I should ask depends on what? Risk of the asset. Measure through beta. Yes or no? Who tells you how to find required return? CAPM. What required return? RF plus beta into RM minus RF. Here I don't see what dividend they are going to give. Everything I forget. Yeah. For the risk taken for that share, I want how much it is called as what? Required return. In our case 14%. Adum KE da. Yes or no? Now, with that KE, I should have paid 25 rupees for the share price. But if the share is trading at what? 20 rupees. I invest 20 and get some dividends or not. That gives you a return or not. It is called as IRR. It is called as what? IRR. The IRR is how much percent? 16%. It is called as what? Expected return. Or the expected KE. Yes or no? The two KEs here. Required KE. Expected KE. If the expected is more than what I require, good share, buy it. Otherwise what? Bad share, don't buy it. Is what is the conclusion. Are you following up? Now, let's start doing the problems in this regard. Now, what are you doing? All are examinations. That is what they ask in examination. It may be very simple. Don't be afraid. Now, too difficult also afraid. Too simple also is what? You'll become afraid. These are all examination sums. Is what they ask in the CAPM. Can you start or not? Now, let's take the first question. Take question number 12, please. Now, let us quickly start doing the solutions. From now onwards, you should only tell me the answers. I'm only discussing that sort. Okay, take question number 12.
Thank you, friends. OMSAI Bhojanapalli.